I have to say that after that, trying to prod and poke Jarrod into really understanding how and why they think the way they do and feel so strongly about it and so different to the rest of the market, he's kind of convinced me, to be honest, that it does seem like it's unnecessary. Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 18th of May 2026. I'm Head of Research Nick Goodall, and I'm joined as per usual by Chief Economist Kelvin Davidson. Kelvin, let's get straight into it today with a chat about the Pain and Gain report, which we released last week. Do you want to take us through the insights and how that release went, mate?
Yeah, so I suppose the broad picture is a bit more pain for resellers we're talking about here, and I guess a bit less gain. So what we do here is look at the latest sale price for a property and how that compares to what the owner originally paid, however long ago it was that they bought that property. So it's sort of a measure of gross profit effectively. We don't necessarily look at sort of renovation costs or that sort of thing. So it's, recognising there's going to be some little changes to the figures potentially in terms of a real profit. But if you simply look at sale price to sale price, it's that kind of gross measure. And so for all those properties that resold in the first quarter of the year, about 88% sold for a profit, or in other words, about 12% sold for a loss. So those figures are weaker from a seller's perspective than what they were 3 or 4 years ago. At the peak, that resale percentage was up at 99% or even slightly above. So, in late 21, early 22, almost every property sold for a gain. But roll forward to now, we know property values are down. It's a buyer's market, so that resale percentage has come down a bit to 88. So, it's down quite a lot from where it was, but still, it's still roughly 9 in every 10 properties do sell for a profit. So I suppose it's, a bit of context is important. For those properties that did sell for a gain, the median profit was 285,000. So still, not nothing to be sniffed at, I guess. But at the peak, that figure was up at 440,000, I think. So that has weakened a lot as well. But it's still, it's still a decent chunk of money for those resellers. Now, the really key thing is hold period. So we say it every time, but for those properties that were resold for a profit in the first quarter, median hold period of about 10 years. For those properties that sold for a loss, the median hold period was about 4 years. So, if you hold for 10 years, yes, we've had a downturn in property values over the last 4 years, but if you've held for 10, you're going to be selling for more than what you paid in most cases. Now, on the flip side, if you think about that hold period for losses of 4 years, think about their last 4 years. I mean, that implies that you bought at the absolute peak of the market and you've had to sell again at sort of the bottom of the market effectively. So it's going to be a pretty tough period to be buying and selling again. So in such a short period of time and aiming to make a profit, I mean, that's going to be pretty rare. So hold period plays a big role always, and especially at the moment, because a short hold periods means you're buying and selling in such a weak market. So those, I suppose, are a couple of the big things. I mean, regionally, there's still some regional stories in there. I mean, it kind of fits with what we know from wider property value data. I mean, Auckland's a little bit weaker in terms of resale performance. Wellington's a bit weaker. You're looking at, apartments being weaker than standalone houses. That's always the case. So I'm not sure there's necessarily any great news in there. It's not like apartments are collapsing, but they do get less capital growth or capital gain over time. So, at any point in the cycle, there's more chance you're going to sell for a loss simply because there's been less chance for gains to build up. So I think that's sort of underpinning that apartment number. And investors selling a little bit more often for a loss than owner occupiers. I think that's probably tied up with the apartment thing as well, that, investors will tend to have apartments, I guess, a bit more than owner occupiers. So those things sort of stack up. But really, it's probably more of the same. We know it fits with the fact that buyers are in the ascendancy at the moment. There's lots of listings, property values are down. So you'd expect a little bit less gain for resellers and a little bit more pain. I suppose looking ahead, it's hard to see it changing really too much. We know that interest rates are up and the economy's weakening and, the Iran thing's going on. So, I think it'll remain pretty challenging for sellers in the next little while too. So, it's great data. People really fight it, and journalists love it. I think the pain and gain thing really, really grabs attention, and we can look at individual sales. I always feel a wee bit sort of uneasy about that, but you can actually look at some of the individual deals and how much the gains and losses were, and journalists like that as well. So it's a popular report. It's a different cut, I guess, of what we already know, but it does just confirm that it's still pretty tough out there for sellers.
Yeah, I think that's it, right? Like it's a nice, simple measure. It's not a perfect measure, as you say, because we can't account for all the costs of selling a property, literally sale price to sale price. But I think the point is that you can analyze the trends. How is it today compared to 5 years ago? What does it look like over time? If you chart that, and that's what we do in the report. So please do go and check that one out. Look at your region, look at your area, look at the charts. You can see the context of where things are at now compared to the last 5 years or the previous downturn. You look at something like the apartments, I think it was 41% of apartments sold at a loss. Yes, that is quite large, but the apartment size of loss is a lot lower, obviously, than houses because the dollar value isn't so great. And also, when you compare it to previous downturns, it's not quite as high as what we've seen in the past either. So you get that full context from the report as well. You can hone into areas that matter to you or property types that matter to you, and go and check that out. But I think, yeah, it is nice because it is a clear, easy thing to understand, but it is absolutely reflective of all the other things we track. Whether it's the home value index telling us that the weaker markets are Auckland and Wellington. Hey, what do you know from this? It shows that, yeah, those people that are selling in Auckland and Wellington aren't quite doing as well as those that are selling in some of the regions. So it does reflect a lot of the insights that we know. It just puts it in a different terminology or a different way, I guess. And of course, we get to split it all those different ways as well, whether it is owner type, property type, location, as I say, just gives that extra detail for people to be able to understand the market in a bit of greater detail. And as you say, often we always turn our mind to what does it mean for the future? Probably much more of the same. I think, again, it probably rams home that point that we've been talking about for a while now, where, especially for an investor, you've got to be looking at a property and making the finances stack up on yield. Expecting the same capital growth in the future that we've seen in the past is just not quite as sensible anymore. And that's not to say we're not going to go through another growth cycle at some stage in the future, and that growth cycle might see some strong annual growth over some periods of time. But longer term, we do expect that growth rate to look lower. And, that's a reflection of a lot of things that we've spoken about a lot on here, right? We've got less restriction on land use. Obviously, interest rates can't fall as far as they have in the past. We've got higher incomes now that can't double necessarily once again. And there is this talk, of course, of some form of, capital gains tax or change to the tax system, whether it's this year and through the election and next election cycle, maybe not. But at some stage in the future, we're likely to see that change. And I just think that, this is just another one that helps us to have that stronger conversation with people to sort of really push home that point. So yeah, great report as per usual. Did seem to get a lot of coverage. I know that you were pretty busy with things, whether it's, media stuff itself or other work things that I did a media interview for it as well, live on Radio New Zealand. And again, talked about all these things that I've just spoken about. So, if it's overflowing to me having to do some of the media coverage, then you've obviously had a busy time of it yourself. So as you say, the journalists like it. It obviously gets good reading numbers as well. And so that's why they put the story high up as well. So yeah, no, success as usual. Good insight and well done on the release. Anything else jump to mind on the pain and gain before we move on? Any other questions or big things that you had from journalists?
No, I think that's pretty much it. Yeah, it's like I say, it's just a reflection of some other stats, but it's got a catchy title, and we can go in different breakdowns. So yeah, people always love it.
Yep, no, all good. All right, mate. Well, I thought there's a couple of things we can cover off from a sort of external data perspective on that macroeconomic environment. I wanted to focus on the selected price indexes for April. It's obviously our best insight as to what's happening with inflation. I'm obviously wary that, most of the figures in there tell us what we know, that, prices of some things, particularly anything tied to diesel and petrol, have increased more dramatically than others over the month and over the last couple of months. We still want signs of what second round impacts are. So I suppose we've got to be mindful of that when analysing these results. But let's look at that briefly. The other one that I don't think we've spoken about much, and maybe there's still some, misunderstanding of, is what's happening with migration and migration numbers at the moment as well. So I'm keen just to touch on those figures as well. But yeah, do you want to take us through the selected price indexes data and any insights you sort of took from that, and, maybe how the Reserve Bank might read this as they come to decide, what's going to happen with the official cash rate? I guess it's next week. Yeah, it must be next Wednesday.
Yeah, so these are monthly indicators or monthly data on prices. Covers about 45% of the benchmark quarterly CPI, which is obviously what the Reserve Bank targets with the official cash rate. So, this is a partial indicator, but it's monthly, so it gives us that updated view on pretty much half the CPI basket. So, it's pretty closely watched. It is the more volatile things, so-called tradables, your petrol and diesel and airfares and energy, this sort of stuff. So yeah, you need to keep in mind that it can be a bit up and down from month to month. It covers food as well, which it can have some seasonality in there. You strip out seasonality by looking year on year, but you can have weather events, and so there is probably a bit more volatility in these numbers. But if anything, the numbers, even notwithstanding the fact that diesel and petrol and airfares and everything were up a lot, some of the other parts of this basket, this 45%, were perhaps a little bit softer than what people were anticipating. I think the general view from the sort of bank economist commentary towards the end of last week was that it was kind of, maybe a little under what they were anticipating overall. Yes, some segments were up, but also some segments were a little bit weaker. And particularly this idea that, in areas where there is, domestic price setters have a bit more, I guess, ability to change their prices, that perhaps looking at consumers going, well, consumers is battling a little bit, might be a bit price sensitive. Maybe we won't push through those price increases, as opposed to things like diesel and petrol, where there's no choice. But some of those domestic ones, maybe just didn't change their prices as much as what people might have been anticipating. I'm thinking here things like, I guess, hospitality, accommodation, these sorts of things. So overall, it probably wasn't necessarily as bad as what might have been anticipated, but that's not to say it was great either, because inflation is definitely up. We know that petrol and diesel and things carry a big weighting, and they're up. So it's a bit of a relative thing. Maybe it wasn't as bad as what people thought, but it's still pretty bad. So but in terms of what it means for the Reserve Bank, I mean, the stance on that was kind of pretty neutral too. I mean, there's inflation pressure, but we know it's in the things that they can't really control anyway, and it's in the things that they've already said they're prepared to sort of look through those first round price effects. So I think this one's probably just a sort of, no, I mean, it relates to April, we should just say. So, a couple of months into the Iran conflict, I guess we should just say it's there. It's been noted. It was there was good and bad in it, but it's probably what it means for the Reserve Bank is not a whole lot. They'll probably just think, well, it was probably broadly in line with what we thought. We'll just have to keep watching and waiting. And the big thing is those second round price effects. Higher inflation expectations, higher wage demands, which I think we talked about last week. That maybe there's a wee bit of caution around that too, because unemployment is higher than where it would normally be. So. Yeah, lots to watch. I guess this is part of the puzzle. It wasn't necessarily clear in either direction what it means, but something to keep an eye on, and the Reserve Bank will certainly be doing that. But does it, put it this way, does it raise the chances, for example, of an official cash rate rise in May? Probably not. And I think those chances are still pretty small anyway, and that probably hasn't really changed. So, well, I guess we're still just watching and waiting, really.
Yeah, and enough in there, I suppose, for them just to go, cool, there's nothing in here to freak us out. So the value of waiting longer and waiting for more data and more information is stronger. So I suspect that, that should be a relatively easy decision. I mean, that's a long, they have in their forecast, of course, they don't have an official cash rate lift in May. So, you wouldn't say that anything between the last monetary policy statement and this one should have them changing their mind on that. So I suppose that's more reaffirmation, I guess, that they can stick to that plan. What could be really interesting, is that there's a potential for them to be publishing not just the vote, but also who voted which way, some of the reasoning behind that too. So I think it'll be really interesting from that perspective, because it could give us a feel for how they might be thinking in July, depending on what data becomes out between now and July, of course. That's the one that seems to be up in the air with, some banks pretty clear that it should or will go up, and some very clear that it definitely shouldn't. That's the thing I'll be looking for, I think, is to say, is it going to give us any hints as to how they might be thinking come July, depending on how the data plays out between now and then? I have to say that I touched on it last week, that I was in a conference last week, and, rather than have two separate presentations from a bank economist and then me, we actually did a joint thing with Jarrod Kerr from Kiwibank. And of course, they have been the outlier with saying, there is no way the Reserve Bank will want to be lifting the official cash rate in July. This demand destruction in our economy from the fact that we're paying more for diesel and petrol and everything is meaning we're spending less elsewhere. That's going to drag down inflation. You don't need to fight this, and all you can do is ruin the economy even more than it needs to happen. Really interesting to be on stage with him. I suppose it turned out, I think I might have touched on it last week, that I was kind of being able to play that devil's advocate and ask him a few more questions. And but what about this? But get into a bit more detail about it. And I think the session went well. I've got some pretty decent feedback on it. And, I have to say that after that, trying to prod and poke Jarrod into really understanding how and why they think the way they do and feel so strongly about it and so different to the rest of the market. He's kind of convinced me, to be honest, that it does seem like it's unnecessary. Now, all of these things are data dependent, right? So they're all saying, we think that come July, this is the state we will be in from an economic perspective, and this is the reaction we expect the Reserve Bank to do, or expect the Reserve Bank to do, should do. And so, I think they're all liable to change their minds depending on how the data plays out between now and July, of course. But given the expectation of how Jarrod puts it, I do think it seems like there should be no real necessity to do that. Again, it'll depend on the Reserve Bank's outlook here. And as we talked about, the path of least regrets. They might still come to that point and go, it may not be necessary, but we still think that the worst thing for our economy is higher inflation for longer. If there's any hints of that happening, we're still going to do it, as opposed to trying to protect the economy, I guess, even if they're, comfortable-ish that inflation isn't going to stick around as long as maybe some of the other banks economists do anyway. So, yeah, that's kind of where I land on this off the back of, like you say, the index data weighing up the potential impacts, and it is that stickiness, that second round impact. I'm going to lean towards, we shouldn't have to see that. But again, it's still 3 months away, so we'll wait and see on that one. The other thing that's in this data, of course, Kelvin, are the property rent data, which did show a little bit of a lift in property rents. And I know that we've probably been, for a few months now, a few quarters, we've been talking about how rents have actually been declining in some areas, particularly Auckland and Wellington. What's your take on this data being released? Is it a change in trend? How much do we put in this? And maybe we can then flow that through to the chat around migration. Obviously, migration and people moving to the country, fewer moving away, is a measure or is a contributor towards rental demand. So, yeah, do you want to just sort of wrap up that data as well?
Yeah. Part of the selected price index's measure is property rents, and in the year to April, they were just slightly up, 0.3% up. So, maybe there's some signs in there of a not necessarily a turning point, but at least a trough for rents. Maybe. I mean, if you look at February and March, they were still down quite a lot. So, and I've been talking to a few people about this, sort of, in the know around the rental data and stuff. And there's just a lot of volatility. I think there's some underlying issues potentially with these rent figures around when bonds are recorded and how they're recorded. And so I just think, with the falls in February, March, yeah, there was a bit of a rise in April, but there's just so much volatility that I think it's just a wee bit too early to sort of say, yep, rents have troughed. Not only that, that's a Stats New Zealand measure, but when you look at MB, or the Ministry of Business, Innovation and Employment, I think it is, their numbers based on bonds, or the sort of flow measure of rents, a kind of new tenancy sort of measure, they're still down kind of 1 or 2% annually. So I think it depends just a little bit on what you're looking at. Do you trust the data? I think there's still just a little bit of uncertainty around that, and a wee bit of volatility. It can be up 1 month, down the next. So, I still think it's still just looking pretty soft out there for rents. Does tie into migration, as you said. I mean, the migration numbers have turned around, and reasonably strongly as well. We had, over the past 12 months, or the 12 months to March, we had almost 25,000 net migration. At the trough, going back sort of 6-7 months, August last year, it was down at 11,000. So, it never actually went negative. We still had more people coming into the country than we had people leaving, which is maybe a distinction that people haven't quite caught on to. Yes, lots of people leaving, but there were also lots of people coming in as well. So it was the net result of two big sort of gross flow numbers. It's come up from 11,000. It's up to around 25, maybe still a little bit below average, but not too far away now. So we kind of, you might be able to say we're sort of getting back to some kind of normality really for net migration. It's reflected fewer residents leaving, but the bigger influence has probably been more new migrants coming in. So, both of those moving parts have shifted in the sort of favourable direction, I guess, if you want to see net migration. So both of those have shifted, and that net balance has picked up. So, yeah, back to 25,000. I mean, it will be adding a little bit of demand to the rental sector for sure. But I just think there's still a bit of uncertainty around those rent figures. The level of rents is still very high in relation to income, so I think there is a tenant affordability restraint there as well. And yeah, there's still a decent supply of rental listings out there. So yeah, demand's picked up a bit, but there's still supply, and rents themselves are still very high. So I think there's reasons to be just a little bit cautious about that rental sector still, which tenants will be sort of pleased to hear. Maybe investors not so much, but I think that's kind of where we're sitting now. So yeah, we'll keep watching.
Yeah, absolutely. Yeah, I think that's the point I wanted to make as well, is that, I was talking to a conference last week for Quinovic, so property managers, and just made the point that, I don't know if it was necessarily expected by them, but I did get this feeling that, maybe not from that group, but it has been over the last few months that people think that we've actually lost population, and maybe it is because we've lost so many Kiwi, particularly to Australia. So migrants have definitely, citizens or whatever, those residents, we have had a negative flow of them, but we have still had positives. And so that generally obviously means more demand for rental properties, but also more demand for our goods and services, right? So that's a contributing factor to what could be a growing economy. Now, you get into debates of productivity and that we need more growth per person, not just more growth because we've got more people. So we're not going to go down that route, and we're not going to get down into conversation around the migration policy or anything like that and how that's going to go. But I just think it's a worthwhile point to say we do still have more people moving here than leaving, and they still need a place to live. And so that does feed through to rental demand. And as we regularly point out, rents themselves, rent prices are a function of demand versus supply, and not necessarily what the landlord's expenses are. They can't necessarily pass on their increased expenses, and they'll be seeing increased expenses themselves. And they can't necessarily force that through in higher rents because, as you touched on, rents are pretty unaffordable right now as well, pretty expensive compared to income. So I think when you weigh all that sort of stuff up, you go, yeah, that rental market, it's kind of, makes sense to see it not worsen maybe because we are seeing more people move here and fewer people leave, but it's not like it's going to storm away. And because we've got broader cost of living crisis still, I think in general, our household creation numbers will be low, right? People are living at home with their parents longer. They're going to live in larger flatting situations longer. If you think about if you're a couple and you're living with some friends, I'm sure people want to be moving out of that situation earlier, either buying your own property, and we've seen lots of that happening, of course, with our strong first home buy numbers, or moving into their own flat, where it's just two people, couple, living by themselves, not having to have other flatmates. Generally, people desire that situation. That probably hasn't happened as often or as fast as people generally would like to do that because they're trying to keep their rental costs down because they're paying so much on all their other costs as well. So I think that you've got to weigh all these things up and go, yep, demand might be increasing slightly, not as much as it could if we weren't paying so much on all these other items that we've got to do to get by in our lives, whether that's food, I say energy costs, of course, petrol, diesel, all those things that are affected by that, transport costs. That I think is just going to hold that demand back. And of course, from a supply perspective, yes, more rental supply on the market, and we continue to build lots of property too. Certainly from a consenting perspective, those numbers have continued to grow, though I would say we're expecting those to, at the very best, stall coming up with the cost of building increasing and obviously confidence reducing in the broader economy. It's going to flow through the construction industry too. So we're not going to build quite as many properties, I wouldn't think, in the future as we had been more recently. So yeah, look, I think that was a good one just to tie all that together anyway in terms of rents and migration, and of course the selected price indexes. Only other things on my mind this week, Kelvin, we've obviously got the monthly video been recorded. That should be out later today, I suspect. So that'll be on our YouTube channel either today or tomorrow. Chart pack out this week. That should be live on Thursday, maybe sooner. So keep an eye out for that one. If you're signed up to our newsletters and regular updates, you should see that one come through by Thursday at the latest. And then I just wondered if you had any other insights from your trip to Auckland during the week. I've had my trip to Auckland and Taupo later as well, but probably just touched on the key things that came out of that from my perspective. Anything else on your mind this week or other news or from your Auckland trip, Kelvin?
Oh, yeah, just a wee anecdote. I was at a couple of events last week, and one thing that stood out was still a lot of, it's anecdotal, but still a lot of concern amongst, I guess, the investment community about interest deductibility. That seems to be just a really big factor for people at the moment. Thinking about buying a rental property, going, wow, I don't know, elections coming up. Could we see a change of government? Will we see interest deductibility phased out again? Now, I haven't actually heard Labor or the opposition parties actually talking about that. Yes, they've definitely talked about capital gains tax, but interest deductibility doesn't seem to have come back onto the radar yet. So, watching and seeing, I guess. But yeah, that seems to be a really big thing on investors' minds at the moment is what happened if, what will happen to my cash flow which is going to allow you to keep that property. What will happen to that if deductibility is phased out again under a different government? So, it's still a wee bit away. And as I say, we haven't heard it really talked about, but certainly it's on investors' minds. So I think that's something that people will definitely be conscious of and one to watch is, I guess, because the election is going to come onto the radar at some point. It doesn't seem to be there yet, but it will at some point, and that seems to be a big factor for investors at the moment.
Yeah, funny you say that because it came up for me too. And I personally, I kind of tend to agree with you. We haven't really heard it from any genuine sources that age deductibility could come back. So I'm kind of expecting it won't. And I think the conversation seems to have switched. I just don't think that type of policy, and there was a lot of criticism about it, whether it was, I think it's just a difficult policy or it's not a smart policy in terms of how it's managed and the function of it, I suppose, in general is not exactly great. So I don't know if it's, something that you really want to see alternating and flip-flopping every time the government changes, that they're suddenly going to bring it back and take it away. I wonder if it just might have been put to bed, but totally agree. There seems to be some consideration for that. So still worthwhile being mindful of. I do wonder if it's more comprehensive capital gains or some other form of tax. And again, not necessarily will happen this time around, but maybe one for the future. So yeah, it's a good point on that one. But all good, mate. Well, that'll pretty much do us for economic and property market chat today. We are relatively short on time, which perhaps might be a good thing, so I can claim ignorance is best. And the A-League is all finished. The Phoenix obviously fell slightly short in their bid for winning the A-League on the women's side. What a heck of a season. Incredible given where they've been, and to even get to the finals, a huge result. Of course, it's gutting they didn't quite win it, but no doubt they were second best on the day, so pretty tough. But that must mean the A-League's finished for me. There was a final on the weekend, so my mind is completely blank on the A-League. And if we turn to any other sports, mate, the Canes obviously march on, looking like a final with the Chiefs, one place or another. So we kind of see how that one plays out. And then I just had to touch on the Warriors. Gotta say, the Magic Round does look absolutely magic over in Brisbane. The Warriors, amazing how well they did. I can't believe, of course, they lose their halfback, Tanner Boyd, after they, basically let Luke Metcalf, who was the number one halfback, sign for another team, the Dragons, from next year. So he's still at the club, and so maybe he just has to, definitely play for the rest of the season. I wonder if there might be a clause to get him out of that one, but I suppose Boyd could be back by next season anyway, but sounds like a pretty tough injury. But they were still too good, and way too good for the Broncos. So, Warriors season continues on as well. So, certainly plenty of positives in there to talk about, mate. We can ignore the non-positives.
Yeah, I don't even know what you're talking about on that other non-positive. Yeah,
Good man.
Yeah, but the Wires, Brisbane's still a good team at home. Magic Round in front of their crowd, and it wasn't even a contest. So I don't know.
It looked like a Warriors crowd, to be honest.
Yeah, that's true. Yes, it did. Yeah. So is it the Warriors here? Who knows? But couldn't be going any better than they are now. So even despite the injury, they still dominated. So
great depth.
Yeah, on to next week.
Yep, cool. Anything else on your mind, mate? Sports, personal, otherwise?
No, that's it. Yeah, quiet weekend, busy week ahead, so we'll get into it.
No, nice one, mate. All right, well, I will leave it there then. Thanks for, as per usual, for your thoughts and insights and everything that happened in the last week. Always appreciate that. And I want to say thanks very much for listening. Please do get in touch with any questions or feedback. Always keen to hear what's going on in your world. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.